A little over 3 weeks ago, Coinbase's institutional arm released a report which covered some of the most interesting trends for the first half of the year. It seemed to fall through the cracks, and it wasn't really covered by many media outlets. Now this is a crying shame, because when I stumbled across it, I found it to be a literal treasure trove of information. Not only does it have insightful data, but it also goes over some of the most interesting trends they are seeing in the crypto institutional space. A space that we know has been one of the most consequential for crypto over the past 2 years. Today, I'm going to be breaking that report down and giving you some of my own thoughts on it. I'll also be explaining exactly what this means for your portfolio, so don't go anywhere. Before we embark upon our quest, I must swear a solemn oath before my fellow travellers. Yea, though I be a true and brave knight of the Order of Crypto, slayer of the great dragon Fud and scourge of shills and moonboys, I am, alas, unable to give counsel on matters numismatic. Which is to say, in thy coarse tongue, I am not a financial advisor, and nothing in this moving tapestry is financial or investment advice. The heroic deeds and wise words which followeth here are for thy merriment and enlightenment alone. If here we meet for the first time, I am Sir Guy, the Lord and Master of Castle Coin Bureau. If thou wisheth to join me on my glorious quest, strike that subscribe button with thy sword, and let thine arrow fly at that little bell. That way thou shalt never again miss one of my proclamations. Before we ride out, tarry a moment longer and cast thine eyes upon the timestamps in the video timeline. They are there to guide you on your journey through this merry land. Jump around as thou willst, yet know too that true wisdom awaits those who keep watch until the very end. The time hath come to unlock the secrets of Coinbase's institutional report. To horse, and let us ride to glory! One thing I like to do before I read any sort of research report is to make sure that I know everything about its authors. In this case, I'm sure that everyone here has heard of Coinbase. However, Coinbase Institutional, called Coinbase Prime, is a really important division of Coinbase. It facilitates some of the largest institutional crypto flows and executions in the market. For example, I'm sure that you've all heard about those massive purchases of Bitcoin that MicroStrategy has been making. Well, for many of those large block deals, they used Coinbase's Prime execution service. Back in December, Coinbase Prime helped to broker a $425 million Bitcoin buy for MicroStrategy. Now, while this may have been one of the most well-known Bitcoin deals, it's more than likely that Coinbase has brokered many more of these over the year. That's because Coinbase's institutional volumes were many multiples of its retail volume. For example, in the second quarter of this year, they stood at almost double the retail volume at $317 billion. I should also point out that institutional trading volume is up by over 47% last year compared to retail trading volume, which is up only 38%. Not only this, but Coinbase expects a significant increase in institutional revenue and volume for the rest of 2021. It sees this coming from not only its existing clients, but also those new ones that it onboards. It's also worth noting that trading is only one aspect that's offered by Coinbase Prime. It also offers custodial solutions to its institutional clients, another business line that has seen an explosion in growth and asset volumes. So that's Coinbase's institutional business. And you can be sure that given the reach of this, it knows a thing or two about what's shaping the market. And it's with that knowledge that it released its semi-annual institutional report. So, without further ado, let's jump into the first section, Bitcoin. The first chart looked at here is Bitcoin performance compared to some of the other asset classes out there. Now, despite the recent drawdown from May, it's still pretty surprising to me that Bitcoin remains one of the best performing assets out there. The next best performing asset here was the Nasdaq 100, which was only up by 44%. Gold was a lot more paltry and did not even register. This is perhaps most surprising to those gold bugs who look to the yellow metal as a hedge against economic uncertainty. Another really helpful metric to look at is the realized capitalization of Bitcoin. Now, this can sometimes be seen as a more reliable indicator of Bitcoin's market cap. Basically, it only calculates the market cap of Bitcoin that has recently been moved. In other words, all those lost coins are discounted in the calculation. Anyway, the realized cap of Bitcoin has broken through all-time highs in the chart here. I also took a look at a more recent measure over here on Glassnode, and it's back at all-time highs. As Coinbase noted here, BTC stored $657 billion as, quote, institutional investors such as traditional hedge funds, endowments, and corporates increased their exposure over the period. So that is the realized market cap measure. Oh, and by the way, if you'd like to learn about a number of other helpful Bitcoin on-chain metrics, I have a video on them. Feel free to hit that link in the top right to come back to later. Now, price appreciation is one thing, but it also has to be viewed as it relates to the risk of holding said asset. And this risk is often measured by the volatility. Cryptocurrencies are known to be incredibly volatile assets, and this is of course reflected in the stats. Here they've presented Bitcoin and Ethereum's rolling 30-day volatility, as well as with a number of different assets. BTC and ETH have also had higher rolling volatility in 2021 than they had back in 2020. So it's quite clear that Bitcoin and Ethereum are still risky. But as any financial analyst will tell you, it's a balance between risk and reward. And that is why it helps to take a look at this in the context of the returns. There are a number of financial ratios that can be used to judge this, but one of the most well-known is the Sharpe ratio. Quite simply, it's a ratio of the average expected excess return over the volatility. It shows how much excess return can be earned per unit of risk. Here it shows that Bitcoin and ETH have better risk-adjusted returns than most of the other assets on the list. More than the Nasdaq 100, S&P 500, and way more than gold. However, there's one more ratio that they decided to look at, and that was the Sortino ratio. This is basically a ratio that only takes into account downside volatility. Instead of using the standard deviation completely, it takes a look at the standard deviation of negative portfolio returns. Based on this measure, Bitcoin and Ethereum both did well versus the benchmarks. Moreover, when it comes to both of these ratios, they are up considerably from last year. Positive momentum. Now, another really important metric that I've constantly been looking at when analyzing Bitcoin is, of course, correlation. The reason being is because this gives a good indication of just how much diversification benefit comes from holding Bitcoin or ETH in an institution's portfolio. Well, here is the correlation matrix that has Bitcoin up against ETH and a number of different traditional assets and indices. This is the correlation of daily returns since 2016, so you can tell the data is quite robust. Anywho, as you can see, the correlation between these crypto assets and other traditional assets is relatively low. The highest correlation I can see for Bitcoin and a traditional asset is with the MSCI World Index at about 16%. This is hardly considered statistically significant. So what this shows us is that institutions can actually reduce their portfolio risk by holding Bitcoin if they don't already. I've linked to an article that covers it in a bit more detail should you want to read up on it. The next graph that they have here should appear bearish on the face of it. This is the total Bitcoin hash rate. The more miners there are hashing on the network, the more secure it is and the less susceptible to control. As you can see, the Bitcoin mining hash rate has been plunging over the past few months. That is all as a result of the Chinese government's crackdown on Bitcoin mining. Now, I've talked about this in great detail in this previous video of mine. Hit that link in the top right if you want to watch it. Yet, as I pointed out in that video, these miners are more than happy to take their hash power somewhere else, and this is exactly what they have been doing. You can even see the distribution of world mining power since the ban and how China is losing its market share. This is something that Coinbase also notes. It states that the increasing competitiveness of clean energy around the world, coupled with balanced regulation in more democratic nations, will lead to a further decentralization of global mining power. So that's not a massive concern of mine or theirs at the moment. Now, one more metric that they have decided to look at here is the amount of active wallets on the Bitcoin network. These are defined as those wallets that have non-zero balances in them. As you can see, this has also been on a sustained rise over the past 2 years. Coinbase actually also notes that it's perhaps undercounting real user adoption because most people use hosted solutions, i.e., they do not self-custody their Bitcoin. This is something that I always advise against, but if Coinbase thinks it's a bullish sign, well, I'll take it. Okay, so that was Bitcoin. But the real performer over the past year was not Bitcoin, but rather ETH, and that makes up the next section of the analysis. That's right, ETH was the best performer of those compared here when looking at the returns over the last 12 months. Up over 895%, and likely much more today. Coinbase says that its institutional practice can identify a number of factors that have contributed to this growth. They include the following: usage in DeFi protocols, investor optimism around ETH 2.0, EIP 1559, and the rise of Layer 2 scaling solutions. Now, I don't have time to go into all of these here, but I have covered them in much more depth in my recent Ethereum video, and it's linked to in the usual spot. Anywho, you'll find this point over here quite interesting. It notes that many of Coinbase's largest institutional clients were ETH virgins initially, but decided to start adding more of it to their portfolios, believing in its long-term staying power. Another really bullish indicator for Ethereum as a network is the amount of daily transactions taking place. This reached a peak of almost 1.7 million transactions a day back in May. The reason that this is a bullish sign is because it shows pure protocol adoption. Just for a comparison, the most daily transactions that the Bitcoin network has reached over the past year was just above 400K, over 4 times lower than the transactions over on the Ethereum network. Moving on though, the next page of the report is also particularly enlightening for ETH. And that's because it gives an overview of the total volume that has taken place on the Coinbase platform in the first half of the year. While total Bitcoin volume is up 489% to $2.1 trillion, the total volume on ETH is up over 1,400% to over 1.4 trillion. Moreover, as I pointed out in my most recent ETH video, Q2 of this year was the first time that ETH volumes exceeded those of Bitcoin over at Coinbase. Pretty crazy stuff. Now, moving on with the report though, the next section after that explores the crypto market's liquidity. This is very important as it's able to show just how well the market can handle large orders, the type of orders that institutions are likely to place. Moreover, the better that these large orders can be absorbed by the market, the less room there is for volatility. Now, liquidity is actually a hot topic in the crypto space at the moment, ever since Bank of America came out with a study that said a $93 million Bitcoin order could move the price by 1%. Just for a little bit of context about how little that actually is, you would need an order of $2 billion in gold in order to move the gold price by a similar margin. Now, Coinbase has also done a study on the market impact, but unlike the estimates of Bank of America, this was based on actual trade data over at Coinbase, almost 15,000 large orders over the year. When it comes to their analysis, I won't go into the nitty-gritty as it's actually quite complicated. However, the TLDR of it is that they've run a statistical analysis on the market impact of all their orders. These have been broken down according to different tranches of order size. Here is the table and here is the chart. As one would expect, the larger the order size, the bigger the impact on the price. They've plotted out the impact on the price in basis points versus the size of the orders. That is the solid blue line in the middle there. They've also plotted the statistical standard errors above and below the best estimate there. So using this model, Coinbase was able to determine that the actual impact we're likely to see of an order of $90 million is slightly lower than Bank of America's estimate. They calculated an impact of about 90 basis points or 0.9%. So although it's not as stark as BofA's number, it's still pretty high. And the numbers are even more significant when we take a look at the impact over on the Ether markets. Based on orders that took place on their platform, the impact of orders of over $25 million is over 150 basis points, or 1.5%. So essentially, prices can be moved a lot more easily on the ETH markets. Now, Coinbase does note that liquidity has improved considerably over the past year, and that may be true, but these numbers do still concern me, and that is for one prime reason: market manipulation. Allow me to explain. Firstly, the Coinbase data comes from actual orders that were executed using its advanced order routing system, a system developed specifically to have the most minimal impact on the market. However, if a whale wanted to intentionally move the price, they would use a pretty unsophisticated method and dump it on an exchange's order books at the market price. This could likely have a large market impact and lead to a fall in the price of Bitcoin or ETH in the spot market. They could then simultaneously open short positions in the futures markets and profit from the movements in the spot markets. Of course, they could also do this in the opposite direction with large buy orders. The point is that whales can and have used order impact to manipulate the crypto markets. And although they're a lot more liquid today than they were in the past, there is still a long way to go. Oh, and if you're interested in learning how whales tend to play the retail market, then my video on the Wyckoff method is a must-watch. Top right, por favor. Moving on though, there were a few more interesting sections in this report that I'll quickly touch on, and one of those was the ETF outlook. As we all know, the market's fascination with a Bitcoin ETF has been ongoing for over 3 years now. That's for a good reason, of course. A Bitcoin ETF could potentially lead to a flood of capital investing in Bitcoin-linked funds, which would of course lead to more demand for Bitcoin. Coinbase is also excited about the prospect as ETF issuers will, quote, be new clients for Coinbase's Prime broker, and that, quote, these ETF users will leverage our custodial, staking, and trade execution capabilities. They've also pointed out here that many ETF issuers believe they will be approved by the SEC either sometime this year or next year. Indeed, there was renewed optimism that this would soon happen as Gary Gensler became the new chairman of the SEC. They noted that he is more knowledgeable about the crypto space than his predecessors. The report was also optimistic about ETFs' chances on the grounds that there were already a number of these instruments in other countries such as Canada. They mentioned the slew of new Bitcoin ETF applications, as well as the improving conditions for the Bitcoin futures market, which allowed for further, quote, surveillance of the Bitcoin market and its prices. Well, this Coinbase report came out before some of Gary's most recent statements on Bitcoin ETFs. This was at the Aspen Securities Conference, and I talked about it ad nauseum in my video on the SEC. But in those comments, Gary said that he would be more inclined to allow a Bitcoin ETF that was backed by CME futures instead of physical Bitcoin. This would mean that the funds would gain exposure to the price of Bitcoin in a synthetic fashion. Why the SEC has placed so much focus on the futures market, both for surveillance and now possibly backing a Bitcoin ETF, is curious. Either way, this statement by Gensler saw a flurry of further ETF applications being sent to the SEC, some of which were backed by futures. Of course, having ETF instruments that are only backed by futures is a bit of a damp squib. That's because it will mean that these funds won't actually be holding physical Bitcoin and hence won't be picking up any on the open market. Demand to hold these fund shares will not impact on the demand for physical Bitcoin at all. Moreover, relying on synthetic exposure to Bitcoin through futures markets is risky in and of itself. This is because these futures instruments may not be tradable at a time when Bitcoin is being traded. For example, in May of this year, when Bitcoin had that large crash, the CME halted trading in Bitcoin futures. This meant that 2 of those Canadian ETFs had to halt buy or sell orders until the CME futures started trading again. So it could create more problems and market volatility than the physically backed ones. It'll be interesting to see whether the SEC really will approve a Bitcoin futures-backed ETF, and I have a feeling it could be around the corner. Now that's it for most of this video, but I want to wrap it up now with a few closing thoughts. I really enjoy reading these types of reports. It helps me keep one step ahead, and that's because billion-dollar institutions are usually looking 3 steps ahead. This report was no different. It's quite clear that institutional demand is as strong as it's ever been. Volumes from these clients continue to soar and are over 3 times higher than those of retail. This makes complete sense when you consider the amazing risk-return trade-off you get with Bitcoin and ETH. On top of that, holding these assets in the portfolios of these institutions also gives them great diversification benefits which reduce risk. These institutional investors are also getting a lot more excited about the prospects of ETH, and that explains just why there's been so much trading volume. Whether ETH trading volume can overtake Bitcoin's in the third quarter is anybody's guess, but I think it's quite likely. Now, of course, there are still challenges for the market. While liquidity has improved substantially over the past few years, it's still relatively thin when compared to most other traditional markets out there. This limited market depth not only opens the door to inefficiencies, but also to market manipulation. However, if we start getting Bitcoin ETFs that are backed by physical Bitcoin, then this could lead to a flood of liquidity from providers that start launching funds. Having said that, if these are the futures-backed ETFs, then that's unlikely to have much of an impact on liquidity, apart from making it a lot more volatile and disjointed. But I am hopeful that they will approve at least a few ETFs that are backed by actual Bitcoin. Give the people what they want, because no one likes being shortchanged by a faux Bitcoin fund. That's it for my video today, ladies and gents. Yet no video is complete without your much-needed feedback. So please let me know your thoughts on the report. Do you guys think an ETF is likely in the next month? Fire your comments right down there. Oh yes, I also have to let you in on a little secret. The content that you guys are watching here is merely the tip of the crypto education iceberg. I share all the rest on my other social channels. These include my Insider Telegram channel with regular daily market analysis, my Twitter with news and channel updates, my Instagram with behind-the-scenes views and memes, my TikTok with my video pipeline and general banter, and finally my email newsletter. That's one you can't afford to miss and includes my once-weekly view on everything from the hottest coins to exciting trends. I also share a breakdown of my personal portfolio here. The only official links to those are in my dedicated socials page right down there at the top of the description box. If it's not on that page, it's not one of mine. And finally, if you guys found this vid insightful, then help YouTube help me help you. Turn that like button blue and don't forget to subscribe. Ping that bell as well for good measure. Go on. I have an exciting pipeline of videos that you cannot afford to miss. But it's time to say bye as this crypto guy's gotta fly.